Vancouver home prices dropped dramatically in January, with average prices hitting a 2-year low. Combine this with GDP going negative in the last report, plus we are facing the ever looming threat of tariffs, which would result in higher home prices. Ultimately, housing in Vancouver looks to be more uncertain than ever. So today, myself and business partner Ryan, we are realtors in Vancouver who have helped people buy, sell, and invest in the Lower Mainland for the past 8 years. We're going to dissect what's impacting home prices right now. And if you are thinking about buying or selling in 2025, you'll definitely want to hear the stats data that we're going to share in this video because it might sway your decision. Let's take a look. Right off the top, we want to chat about tariffs. And you know what? By now, you might even be sick of hearing about tariffs. So we're going to keep it short. But we want to discuss what actually would impact housing in Vancouver if some form of tariffs happen in 25 days, 100 days, whenever, right? It could be tomorrow. It could be by the time this comes out. We don't know. Nobody can know, I guess, at this point. But let's just do a quick overview here. We are recording this on February the 7th. So at the time of recording, we are during that 30-day pause that was implemented. So who knows how much weight that carries? Anything can happen. On Monday, when the tariffs looked imminent, one of the first things that happened was the chief economist for the Bank of Montreal, Doug Porter, who was on our podcast just the week prior, he would suggest, or he came out and suggested that what would most likely happen in Canada is, first off, zero GDP growth within the rest of 2025. Unemployment rate would skyrocket up to 8%. And the Bank of Canada would then cut rates at every single one of their meetings this year, a quarter point each time, ending the year with a 1.5% overnight rate. The dollar would understandably get hammered even further, landing somewhere around the 64-cent mark. The next day, the tariff threat was pulled back or at least delayed, right? So put that to the side for now. But what has happened since, what a reality is the dollar did in fact hit a 23-year low just this week. And yes, it has rebounded slightly, which I think is good news for us. But again, it hit a 23-year low. The 5-year bond has actually been dropping quite substantially as well. It hit a 30-month low this week. And understandably, fixed mortgage rates are following that downward trend. In fact, today, best rate that I found was a 5-year fixed available at 3.89%. So we're in the high threes for fixed. And yes, that was insured. So real quick here, again, more effects on the housing market and what could happen with these tariffs. Well, right now, I'm sensing almost a little bit of a similar feel, not quite as extreme, but a similar feel to what we saw during the COVID era right out of the gate. And what I mean by that is people are just kind of like, wait and see, frozen. Let's go to the sidelines. Let's let this thing hash out because who knows how bad it could potentially be, right? People are like, well, let's just give it a week. Let's give it a month. Let's wait until that 30 days pass. Maybe we'll have an update that it's 60 days after that. Who knows? But right now it's kind of freezing the marketplace on the buyer side, at least. You know, people don't know. Are they going to have a job if tariffs go through? Will the economy just go to the crapper? Like there's just so many variables and unknowns that understandably making a major life decision, a major purchase, yeah, you might want to put that on the back burner for a minute. Ultimately, in a world where obviously the cost of housing, especially here in Vancouver, simply can never seem to get a break, it would get worse with tariffs, and builders would face increased costs for some of the key items that they need to build these homes, right? This would include tariffs on windows, on drywall, on HVAC systems, on the appliances in your kitchen, on hardware, on steel. All these building materials would see an almost immediate increase in price thanks to tariffs. And that would, of course, get passed on to the consumer, resulting in even further cost of building and a further cost of housing.
Yeah, tariffs, kind of no matter how you split it, at least on our side, they really suck. And the reason for, I think with Trump announcing this, it's done something pretty interesting. It's spotlighted a lot of the interprovincial trade issues or across Canada trade issues that we have. You know, do we see a lot of Quebec dairy coming out to West Coast? And do we have West Coast oil going out to the East Coast? We don't. A lot of things that people don't realize, like the province of Ontario exclusively gets its oil supply from Michigan. It doesn't get it from Alberta. And that is crazy. So, this sort of process, I think, could have some really bad short-term effects. And tariffs, even just the announcement of tariffs, are enough to sort of, I guess it's like a forward indicator that prices for these things are going to go up anyways. And it hedges investment. People back off. You see increased prices and lower levels of economic activity. It's not good for anyone, especially for us, where 20% of our GDP is with one particular business, one particular client, right? That's scary. So we need to diversify. And I think immediately, if we start looking at what could happen as a result, it kind of gets scary. So I'm going to go over what the BCREA has forecasted here in terms of what would take place if a tariff happened and what would happen immediately within our specific market here. So the BC Real Estate Association here presented their predictions on what would actually take place if 25% tariffs were enacted and what would happen if Canada retaliated, because that matters. That's effectively doubling the tariff. So home sales would drop dramatically. We just talked about that, reducing from about 21,000 per quarter down to 18,000. But here's the thing, if Canada retaliates, that drops further down to about 16,000 home sales per quarter. That's about a 30% drop in overall sales volume. That would bring the market to a screeching halt. And we wouldn't see those levels likely return until 2029, effectively Trump's presidency. Let's be honest here, these threats of tariffs, just because they haven't been enacted over the last 30 days, doesn't mean for the next 4 years that they won't be a threat. Active listings, this is also crazy. They would skyrocket from around 37,000 units up to 52,000, or a 40% increase by 2028. It's only about that time where we would see it peak and start to drop. So you could expect a softer and softer and softer real estate market. 5-year fixed mortgages would increase to 6% in 2026 and then lowering slightly by 2028. And here's why. This is an important distinction to make here. If the U.S. tariffs Canadian products, you're actually going to see the central bank, lower rates, I think, aggressively. But in the event that we start tariffing goods coming back from the US, you'll see those interest rates go the other way. And that's because we're importing inflation now. We're raising the prices on all of these items. And in some instances, like if you're talking about cars, where cars go back and forth between plants across lines, like engine parts and all those kinds of things, the amount of like 25% tariff every time something like that crosses it would fracture the marketplaces. So it's really not necessarily in our best interest. I understand the posturing, but not necessarily economically speaking in our interest to retaliate with tariffs. Prices, when it comes to real estate, well, the BCREA is actually somewhat bullish here, and it's due in large part because very few homes would get built, but do expect prices to rise, though quite a bit less if there was no tariffs. So prices go from $970K today to $1,060,000 in 2028. Compared to no tariffs, they would go up to $1.12 million, 6% higher with no tariffs. So it's pretty interesting data here to consider. And Dan, I don't know, and I don't think anyone could tell you which direction this is going to go.
One avenue that might give us some early insight is REW. See, we've interviewed the president of REW.ca a couple times, and post-COVID, it was a very interesting time for them because REW gets an immense amount of data, and they're a little bit forward-seeing in the sense that what do people do first before they buy homes, before they even qualify for a mortgage? They search online. And so right when COVID hit, of course, the searches for homes went near zero, but it was pretty quick afterwards, as soon as even May of 2020, where they saw home searches just absolutely skyrocket, way, way above previous years. And we know what happened after that. 2021, 2022 hit record sales volumes, all-time highs. So it's very fascinating and very kind of important to look at what happens with stats and data and people searching, right? The early indicator. And here's a chart that we'll put on YouTube for those who want to have a look. Literally in Vancouver, home searches peaked on January 19th. in this recent cycle I'm talking about. What happened the next day? Trump's inauguration. And the line basically trends down since then. And yes, it's only a couple of weeks of data, so let's not get too excited here. But what I'm saying is, as soon as Trump got in power, people in Vancouver slowed their searches for new homes. Pretty interesting stuff. Obviously, we're going to keep an eye on this, but that is kind of a flash in the pan or an indicator of where we are today. Expanding on what is going to affect real estate is people's employment, right? If you are worried about your job or you have no job or it's hard to get a job, understandably, buying a new home is probably the last thing on your mind. And just today, earlier today, we had the most updated jobs report, and it actually blew past expectations. Canada apparently added 76,000 jobs in January versus the only 25,000 expected, right? At 3x expectations. And this is on top of the 91,000 jobs that were added the month before. What's really quite interesting is that the public sector jobs actually fell by 8,400, while private increased by over 57,000. And self-employed people, they're out there, 27,000 new jobs created. So ultimately, how did this wash out? Well, the unemployment rate fell to 6.6%. It was 6.7 the month before. And it was expected to increase to 6.8, and now we're down at 6.6. Notably, this is the second consecutive decline in the unemployment rate, showing unexpected strength in our nation's jobs numbers. This is if you believe the data, of course, which, I don't think we have a secondary data reference. So at this point, we'll take them at their word. Now, closer to home, what's happening in BC? Well, the employment in BC rose as well, 0.8%, with a gain of about 23,000 jobs last month. And even closer to home in Metro Vancouver, employment rose by 1.7%. But the unemployment rate, well, that's telling a bit of a different story, because in BC, it rose 0.1% to 6%. And, sure, that's better than the national average, which is sitting, as we mentioned earlier, at 6.6%. And right here at home in Vancouver, Vancouver's unemployment rate rose as well, 0.3% to 6.8%. So Vancouver is actually above the national average. Ultimately, it shows that, well, the wheels haven't fallen off completely yet, right? So unemployment, it's grinding to the right and up slightly, but of course, no extreme spike yet, right? We're not in the 8s. We're not seeing the flashing reds, but we are in the yellows, per se.
Yeah, and let's have a look here now at GDP. Is GDP, as we sort of closed out 2024, unfortunately, the economy contracted by 0.2% in November, and that was the largest monthly decline in a year. With that said, though, there is a bit of a bright note here. There were early flashes for estimates of December showing that GDP has rebounded by that very same 0.2%. This puts the fourth quarter growth back on track for an annualized 1.8%, aligning right on with the Bank of Canada's forecast and improving on third quarter growth of about 1.1%. But let's talk about some of the positive momentum that we're seeing in some key sectors here. So interest rate sensitive areas like real estate, leasing continue to show resilience, growing by about 0.3% in November. And this marks the seventh straight month of gains. And this is thanks to increased activity throughout the Ontario, Quebec, and BC markets. So meanwhile, on the flip side here, construction, that sector rose by 0.7%, driven by a 1.8% jump in residential building construction. So, and this is good. This is the fourth monthly increase that we're seeing here. So we're getting a bit of a mixed bag in terms of the data that we've been seeing here. Some good, some bad, largely trading sideways and weathering the storm.
So that's the economic update for what happened in just the last 7 days. Pretty impactful. And let's have a look at how all that happened in last month's economics pushed Vancouver real estate, because these numbers are interesting across the board. Starting with sales, well, the good old health of the market, a little bit higher than last year, right? Sales ended up about 1,550 units, which is 9% higher than in January of last year. And it's actually the highest January sales we saw in 3 years. But big picture here, still below that long-term average, right? Meaning it's still grinding slower than we're used to the tune of about 11% below.
When we look at new listings here, this is where things begin to get a bit more interesting. January saw 5,546 new listings hit the market. That is 46% higher than January of 2024. It was also the second highest listing month for January, going back as far back as the data goes to 2005. Only January in 2012 was higher, and by less than 180 units. And what happened with prices in 2012? Well, they rose for 4 months, and then they dropped for the remaining 8. And prices dropped about 2.5% on the year. So sellers look to be entertaining the market much more earlier in the year than typical. In fact, maybe more so than any time in history that we've been recording this data.
Understandably, a huge spike in listings is going to carry over into inventory, right? Well, yeah, absolutely. It did this time. Inventory increased 33% over January of last year, over 2024, and came out measuring 11,100 active listings at the end of the month. Now, this is well above that 10-year average, 33% as well above that 10-year. So that's a big lift. In fact, the last time that we saw inventory this high in a January was 2019. And that year, prices dropped as well, albeit less than 1% by the year's end. So are we seeing signs of an early spike in inventory that's going to run through the rest of the year? Or, is this just the people who really couldn't sell in November and December trying again, thinking that maybe it's an early spring market? We've seen all these rate cuts lately. Maybe there's a better chance now than there was in December. Well, let's have a quick look. We're recording this on the 7th, and as of today, inventory has already increased to 12,500. So yeah, it is creeping up, and this might be a year of increased inventory across the board.
And that's showing up in the sales to active ratio as well. That's sitting now overall at 14%, down pretty big amount, 4% month over month. And this is now the ninth month in a row. Sorry, the ninth month, not in a row, the ninth month of being in a balanced marketplace. 9% for detached homes, that is down 3%. We're sitting at 20% for townhomes, that's down 4%. So we're teetering now there, coming into a balanced marketplace. And apartments have entered that balanced space now, down 2%. Pretty interesting stuff, man.
So how are things doing in the world of foreclosures? Are those spiking? No, they're not, at least not yet. So across the board here, foreclosures only increased by 14 units from last month. And right now, if you look for all foreclosures across the Lower Mainland, there's 256. That represents 0.02% of all active listings. And, again, we started tracking this metric in October of last year, and that's when there was 230 of them. So in the last 3 months, it's increased by 26. That is over 10%, but still a pretty marginal number. But again, we'll keep on track of this one and definitely make note of any spikes up or down.
Days on market. So how many days are we taking to sell the home? We're now hitting 34 on average, and that's up 5 days month over month. It's the highest we've seen in 6 years, going back to December of 2019.
So a lot of references going back 5, 6, 10 years in some cases, right? So the year it's shaping up to be quite interesting. Now, price tells a number of stories here, because after 7 consecutive months of decline, as far as the HPI goes, prices actually rose in January by $1,500, right? So right now it's sitting at 1,173,000. I think that's very misleading, because remember, HPI is a lagging indicator. It rose in January because for the last 3 months, median prices have been going up. In the last 2 months, average prices have been going up. So it's just catching up to what's happened historically. But when we look at a more current snapshot, we see a very different story taking place. And let's have a look. Median prices dropped significantly. 80,000 drop just last month, just in January. And this is the single largest drop we've seen in 18 months. Median home prices hit $918,000 in January. And this is the lowest price for that metric dating back to August of 2023. What's more, average prices saw a similar drop, lowering by $70,000 in January, hitting $1.212 million. This is the lowest average price we've seen in 2 years, dating back to February of 2023. These are significant price drops and absolutely worth paying attention to. Now, of course, both metrics come off of multi-month increases, and this is only 1 month of lowering. And obviously 1 month doesn't make a trend, as we always say, but the sheer size of these drops is what's relevant and is very important to track as we go into February and onwards. Okay, so that's the wrap up for January. But what's next? Okay, because right now it certainly feels like sellers are becoming eager to sell. They're seeing the rates come down. Maybe they're getting pressured by their mortgage rate increase. Maybe they're offloading investment properties because they're cash negative and they don't like the tenancy laws. Whatever it is, there's all sorts of reasons that people may be more enticed to list now than they have been over the last couple of years. Maybe the uncertainty of tariffs is pushing them over the edge. Everyone's got their own reason. So we're going to see what happens, right? And if we see a spike in inventory, what usually happens? Well, there's typically a flurry of buyers because they suddenly see stuff that they like, and then it tapers off quite dramatically. And typically, high inventory, means lowering prices. How are we looking? It's early, right? February 7th here. How are we trending for the month? Well, February of 2024 last year saw about 2,050 homes sell, and right now, we're only trending towards about 1,700. It's only 1 week in. It's a bit early to call it. But as we close into what is historically the busiest selling month of the year, being March, we might see that number catch up. Ryan, what are your final thoughts here on what people can expect in our potential spring market, or at least the rest of February?
We always talk about trying to time or not time the market, but rather time in the market. But this might be a time where you might want to spend time maybe at least trying to time the market a little bit here. There's a lot of things that could potentially push prices down from where we are right now. And, I think if you're going to be a savvy buyer, now hold on a second here. I mean, that's not meaning that the seller is necessarily going to sell that property to you if they can't get their price. So there is that. But on the flip side, our prices overall, could they potentially go down before they recover here? I think so. And I kind of agree with what you're saying here with the spring market might be a bit of a nothing burger. It may be until sort of the fall market before things actually settle down here. I mean, there's so much uncertainty with what's going on with Trump. And, that has exposed the larger economy and perhaps where we have to improve as a nation too. What is that going to do for our investment, future investment into Canadian companies and things like that? There's political uncertainty here. We're looking at a potential election in the springtime. I mean, my goodness, there's a lot happening right now. And so, with buyers stepping back and looking and waiting, it doesn't surprise me at all. And sellers, you guys got to be aware of what's taking place here because we are not in the same market that we found ourselves in a year ago.
Market might be taking a bit of reference from the weather. It's freezing. All right. Bad jokes aside, thank you as always for tuning in and watching. Have a great week, and we will see you here next week.